Good afternoon, good morning, good day, depending on where you're listening from. Welcome to Profit and Beauty. Now, this show was created for salon owners who have decided to start running their salons like a business rather than a hustle. The focus of the show is to help salon owners understand the numbers behind their business so that they can grow and make extraordinary profits. Without this knowledge, it's really hard, if not impossible, for your salon to reach its true potential. My name is Desarie Anderson, and I have 19 years experience as a hairstylist and salon owner. I currently work as a certified public accountant, working mainly with salon owners and hairstylists. My background as a former stylist and salon owner gives me a much better understanding of what our industry professionals need and desire. So if you are a hairstylist or salon owner interested in running your salon like a business, then this show is for you. On the other hand, if you are a hairstylist or salon owner not interested in running your salon like a business, this show may or may not be for you. I just hope you keep listening, and maybe something you hear in one of the episodes will make you decide to turn your craft from a hustle into a business that you can scale and grow. So sit back and enjoy this week's episode. Hi everyone, and welcome back to my show. It has been a while since I have actually put out a podcast. Well, as you guys know, I am a certified public accountant, so it is tax season, so I've been quite busy dealing with the season. So I have a bit of a break because March 15th was the deadline for business taxes. So those of you that have businesses, in other words, if you are an S corporation or if you are a partnership, you should have filed your tax return by March 15th. So I have a little bit of a break. So I've decided to put out a podcast. And I think even though tax season doesn't end until April 14th, or rather April 15th, I think I'm going to try to put more episodes out and not wait as long as I did this time. So this particular episode is going to be talking about self-employment tax. So if you are a sole proprietor, if you are a partner in a partnership, or even if you're an S corporation owner and you are on payroll, but you also have income coming in from different areas, or if you distribute money to yourself through your S corporation, in addition to paying yourself as an employee, then you need to know about self-employment tax. It's a very important subject because it's one of the main reasons why people wind up owing the IRS more than they think they should. So I'm going to try to explain this as clearly as I possibly can. And what I'm going to be doing is I'm going to be comparing self-employment tax with the employment tax that you pay if you are a regular W-2 employee. So what is self-employment tax? So if you've been an employee before and you've received a W-2, then you're pretty familiar with having your Social Security and Medicaid payments deducted from your paycheck. So normally the amount deducted usually amounts to 7.65% of your gross income. Now, this percentage is going to make sense in a moment as I move forward. So who must pay self-employment tax? As business owners or independent contractors, by law, we are all required to fork over 15.3% of our gross income to cover our future Social Security and Medicaid payments for when we retire. So that is the purpose of paying self-employment tax as an independent contractor or as an employee. You're paying into your future. So how is self-employment tax calculated? Most W-2 employees don't even realize that their employer matches the 7.65% that's withheld from their paychecks. So as I mentioned earlier, we are all required to pay 15.3% of our gross income into Medicaid and Social Security. So W-2 employees only pay half of that 15.3%, meaning that they only pay 7.65%, while their employer pays the other half for a grand total of 15.3%. So either way, as a self-employed person or as a W-2 employee, you're still having to pay 15.3% into Social Security. The difference is that as an employee, you only get to pay half, and then your employer has to match it. So they're paying the other half on your behalf. So for those of us that are self-employed, we do not have an employer to pay our half of Medicaid and Social Security payments. Therefore, we are required to pay the entire 15.3% ourselves. So here's an example how our self-employment tax is calculated. So Ashley is self-employed. After deducting business expenses, her net self-employment income is $100,000. Her self-employment tax is calculated as follows. So self-employment income is $100,000. Then you multiply that, and this is not really that important to you guys, but you multiply that line by a certain percentage, which is 92.35%. So in all actuality, she's paying self-employment tax on $92,350. Okay, but that's nothing for you guys to worry about. That's just a calculation that we have to do on our end. So ultimately, based on that, her self-employment tax is $14,130 because we're multiplying her self-employment tax by 15.3%. Remember, 15.3% is what we all have to pay into self-employment tax. So Ashley's self-employment tax is $14,130. Now, all self-employed individuals, as I mentioned earlier, must pay self-employment tax if they earn over $400. So if you're a self-employed person and you earn over $400 for any given year, you are required to pay self-employment tax. So if your filing status for tax purposes is single, and let's say you work a regular 9-to-5 job, and your income for that particular year, let's say it's $10,000, then you're not required to pay income tax or even file a tax return because you didn't meet the threshold that's required for you to even pay income tax. So the threshold to file a tax return, if your filing status is single for the year 2018, is $12,000 because, as you know, the tax law changed and the standard deduction now went up to $12,000. So if you make $12,000 or less and you file single, you have a regular job and all you made is $12,000, you're not really required to even file a tax return because you don't have to pay income tax, even though your Social Security and Medicaid tax is still going to be deducted from that $12,000. And for 2019, that amount increases from $12,000 to $12,200. However, if your filing status is single and you are self-employed and you make more than $400, you are required to file a tax return because all self-employed individuals are required to pay self-employment tax on income above $400, no matter what your filing status is. So to reiterate what I just said, the threshold to file a tax return in 2019 for people with a regular job who file single, and when I say regular job, I'm talking about a W-2 employee. So you go to work every day and you get a paycheck and your employer withholds the taxes on your behalf. If you're single, it's $12,200, meaning you don't have to file a tax return because you owe no taxes. If you file jointly with your spouse, the threshold is $24,400. And if you are head of household, then the threshold is $18,350. Under these circumstances, you are not required to file a tax return. But all of that goes right out the window if you are self-employed, because as a self-employed person, you have to file a return if you make more than $400. So the question now becomes, can you reduce what you pay in self-employment tax? And if so, how? So one way is to take advantage of all of the tax deductions that are afforded to you. You want to make sure that you take advantage of all the deductions that you are legally entitled to take. So this is another reason why it's crucial that you track and keep records of all of your expenses. So in one of the earlier topics, we talked about why it's important to track your expenses. This is one reason that it's very important, because doing so can save you thousands in tax bill. Because the less you make, the less in self-employment tax you're going to have to pay. If you are not keeping track of your expenses and you are paying in more than you should or would have had to pay if you had kept track, that means that now you're paying more, of course, in self-employment tax, and also you're paying more in income tax. Now, another option is to form an S corporation. However, I am very, 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 very careful about suggesting this option, because although forming an S corporation can reduce the amount you pay in self-employment tax, there are several rules that you must comply with if you decide to organize your business as an S corporation. Now, this option is not for everyone. So I usually engage in a major consultation with my clients if they are thinking about either forming an S corporation or restructuring their current salon from an LLC to an S corp. Because you can do that. Even though you start out as an LLC, you can always go back and change the way you are taxed and restructure it to be taxed as an S corporation. So we're going to discuss some of the compliance requirements of S corporations in another lesson. But in the meantime, let me provide you with an example of how electing S corp status can save you a significant amount of self-employment tax. Now, please note, this particular way of structuring your business, meaning an S corporation structure, is not always most beneficial for everyone. Okay, it is not always most beneficial to elect to be taxed as an S corporation. You should always consult with a tax professional regarding your tax strategies. So don't do it just because you think that you're saving money in taxes. Yes, you may be saving money, but then again, you may not be. And then all of the things that you are required to do may not be even worth the amount of money that you may save. So let's look at an example. A business owner earns $100,000 after paying business expenses. So normally, self-employment tax on these earnings would amount to $15,300, which is 15.3% of 100K. Now remember that the $15,300 does not include income tax. So you still have to pay income tax on top of your self-employment tax. And that's the reason why people always say, wow, why do I owe so much money? Because if they don't understand the concept of self-employment tax plus income tax, it appears as if they owe all of this money, which they do, okay? So alternately, let's say that same business owner, who is an S corporation, earns $60,000 after paying all business expenses. And he elects to be taxed as an S corporation. In this case, the business owner paid himself a reasonable salary of $40,000. And that's the reason why his earnings after expenses went from $100,000 to $60,000. Because as a LLC or as a sole proprietor, you don't deduct in other words, if you take out money from your business to pay your bills, your own personal bills, or you take out money for personal purposes, you don't get to deduct that. It's not a deduction. Whereas if you are an S corporation, you get to deduct your salary because you're paying yourself as an employee, because as an S corporation, you're required to be an employee of your business, which means that when you pay yourself a paycheck, that becomes deductible from your business expenses. So the initial example was the business owner earned $100,000. Okay. Now, as an S corporation, we are going to take into consideration how much this business owner pays themselves, which is $40,000. So now they're left with $60,000. Okay. So now they grossed, or rather they have $60,000. So now instead of paying 15.3% self-employment tax on the entire $100,000, which they would have to do if they are a sole proprietor or an LLC, this individual, he or she, is now only paying self-employment tax on the $40,000 salary. So the salary that you paid yourself, remember, you still have to pay Medicaid and Social Security, which is called self-employment tax. You still have to, well, it's called self-employment tax for self-employed people. So even though you're an employee, you still have to pay Medicaid and Social Security. But now you're only paying that on $40,000 and not $40,000 salary that you paid yourself. So then this brings the self-employment tax that you paid from $15,300 if you were a regular LLC or sole proprietor to now only having to pay $6,120 because you are an employee of your business. That's a total savings of $9,180 because you don't have to pay self-employment on the $60,000 distribution. So this is where the saving comes in when it comes to sole proprietors or LLCs versus an S corporation. With a sole proprietor or an LLC, whatever is left over after you pay all of your expenses is subject to self-employment tax. Whereas as an S corporation, whatever is left over after all expenses are paid is not subject to self-employment tax. It's only subject to income tax. And that's the reason why, as an S corporation, you tend to save money or pay less in taxes, especially if you make a lot of money. But as I said, don't run out and switch your business structure to become an S corporation without sitting down and speaking to an accountant so they can explain to you exactly how it works. And not only that, you want to make sure the numbers make sense, because the numbers may not make sense in your case, especially if you're making a certain amount of money. It's only really worth it if you are making over a certain amount. So whatever the amount is sometimes personal to you. It just depends. So not everybody is necessarily going to save money as an S corporation. So you want to make sure that if you're going to go that route and become an S corporation, that it's worth it, because there are lots of requirements. There are lots of rules and regulations for S corporations. So if you're going to go there, make sure that it's worth all of the rules and regulations that you are now having to abide by. I hope that made sense. Once again, if you have any questions about this, please feel free to reach out to me. I try to help beauty industry professionals transform their financial life. And not just transforming their financial life from a business perspective, but also transforming their financial life from a personal perspective. Because at the end of the day, what we do for a living is what helps us elevate our personal lives, right? It helps us to save for retirement. It helps us to purchase vehicles. It helps us to purchase homes. It just helps us to go on vacation. Everything that we do in our business lives helps better our personal lives.